My monitor over here is photos of the faces of all the partners that I serve. And so the first thing I see every day when I start work, the last thing I see when I end is here are the people that I'm here to serve. And so it is a partnership in that respect. When I get confused on something, when I need help with something, I'm calling partners. My fund documents literally say, after they kind of describe our strategy, they say this will probably repel most people. But if this doesn't repel you, let's talk. And so we're not trying to be all things to all people. We're trying to be things that, where we feel we can apply practical wisdom in a very long biased, long duration, slow moving, thoughtful partnership.
Welcome to Alternative Universe. This is a show for financial advisors, alternative fund managers, and those who want to navigate the diverse landscape of alternative investments and explore opportunities that lie beyond the conventional. In today's episode, we get the opportunity to speak with John Candeto, the founder and managing partner of the Phronesis Fund, which is a long bias partnership that, as implied by the name, applies practical wisdom and first principles reasoning to patiently compound capital. Which I think is the name of the game, right? We're all looking for that magic in compounding. John, welcome to Alternative Universe.
Thank you for having me. Happy to be here.
Yeah, man. Thanks a lot for joining us. And I love just the name of your fund. And then when I look at you and I see a stack of books behind you, it all adds up. So welcome, man. Why don't you tell us a little bit about how'd you name your fund?
12, 13 years ago, I was living in London. I love jazz, and I went to see Wynton Marsalis. I was grateful to be able to see him, and a band opened for him. It was a jazz trio that just blew the doors off the place. It was at the Barbican, and I went and met the guys afterwards and was like, guys, thank you for your music. And the band was named Phronesis. And I thought, that's a strange word. I've never heard it. And I Googled it, and it's a Greek word that means practical wisdom. And I thought at the time, I hadn't worked out a fund yet, but I thought at the time, if I ever start something, that's the name. And so nice. 10 years later, it was time to start an investment partnership, and I already had the name.
Love it. Love it. Why don't you dig into a little bit about investment partnership? I think a lot of the time, especially when we talk about alternatives, there's some assumptions, whether it's private equity or venture or debt or something. Why don't you talk a little bit about what that means when you speak of a partnership?
Yeah, absolutely. So I went through a journey, as we all do, on kind of figuring out what kind of investor am I, what makes sense to me, what doesn't. And I got to all of that through being an operator. So out of college, I spent a little bit of time at Merrill Lynch, and then I had a brief stint, a few years in strategy consulting, and advised a bunch of businesses. And that's where I got to get inside businesses and say, okay, they certainly have a glossy exterior. What do they look like on the inside? And we were working at very senior levels all over Southeast Asia. And, that was when I first realized that, businesses are, I think Brent Boucher likes to call them, a constant knife fight. And that's it. They don't look that way, but they all are. And a few years after consulting, I spent a decade building an enterprise software as a service business out of London and then eventually Philadelphia, and went from sort of zero to something fairly meaningful. And the story I like to tell is that it was a 10-year journey. It was about 3,000 days of my life, and we raised capital on 3 of those days from venture capitalists. And so on 3 days out of 3,000, we had a stock price. We knew what the options were worth, that kind of thing. And the other 2,997 days, we woke up and the stock price wouldn't have mattered. We didn't have one. We weren't liquid. We couldn't sell. So what did we think about? We thought about our customers. We thought about serving them well. We thought about their businesses and how we could help them be better. We thought about our product. We thought about our team. We thought, that the stuff that business is made of. And so that impacted me as I started investing. For me, it was a hobby that turned into, flying to Omaha for the Berkshire meetings, and then meeting some friends and trying to piece the puzzle together. And the more I did that, with that kind of business builder background, the less the idea of, hey, let's go buy 1,000 securities and call it a portfolio made sense to me. And I don't have any disdain for those that do that, other than, to me, the way I sleep well at night is I know deeply what we choose to buy, occasionally when we sell, what we sold and why, and literally the stuff that those things are made of. And I sleep well at night because I think practical wisdom, phronesis, we try to, wisely allocate capital for the benefit of the partners. To your question on partnership, I've spent a lot of time thinking about that and crafting a structure which will attract the right people and repel the wrong people. And so my partners, I really think of that way. My monitor over here is photos of the faces of all the partners that I serve. And so the first thing I see every day when I start work, the last thing I see when I end is, here are the people that I'm here to serve. And so it is a partnership in that respect. When I get confused on something, when I need help with something, I'm calling partners. My fund documents literally say, after they kind of describe our strategy, they say this will probably repel most people. But if this doesn't repel you, let's talk. And so we're not trying to be all things to all people. We're trying to be things that, where we feel we can apply practical wisdom in a very long biased, long duration, slow moving, thoughtful partnership.
What are some of the things that you think might repel somebody?
All kinds of things. The fund mandate. I mean, one thing that never made sense to me, and it probably helped that I didn't come out of this world, is like style boxes. I mean, I understand if you have, billions in capital, there's an operational simplicity that comes with being able to play the style box game. But, I had small cap fund manager friends, and as COVID hit, they knew they were going to get hammered. I mean, when markets seize up and you have firms that can't access capital, but they were in a style box and they couldn't move. I could go anywhere I wanted. I wasn't running a fund at the time, but I did with my own portfolio, and I wish I'd been running a fund at the time. So, for example, the fund docs basically say, where we deem it wise, and we're doing this in partnership, we can go pretty much anywhere we want. And, while we're not going to run a portfolio of one security or asset, we can be as concentrated as we want. We think about risk, but we don't think about it in the way that financial economists would think about it. We think about risk as, a thought experiment I run with partners and potential partners all the time is Amazon one business or 3, 4, 5 businesses plus an engine that keeps creating businesses? And it's a function of the way our capital markets work that they only get one ticker symbol. So Amazon is one ticker, and those that think volatility is risk say, the volatility of that one ticker is an indicator of risk. Berkshire is the greatest example. Berkshire is 300 private businesses and a bunch of public businesses. Ideally, you'd want a ticker for each of those, and then you could piece that all together if you thought volatility was risk. But we get one ticker. And so, for me, I think, our portfolio right now, we've got 18 positions. I think that's better understood as something like 30 or 40, because some of those are just multi-business businesses. They just come in the form of a single security. And so things like that, where, the fund documents say we make no traditional effort to manage risk in the way that that's usually interpreted. Doesn't mean we don't manage risk, but I certainly sleep far better at night with businesses that have a lot of optionality and resilience built in than I do with businesses that maybe look better on, say a sharp score or something, but are sort of concentrated in ways that are very fragile.
Absolutely. Yeah, that makes sense. And just to be clear, you're not necessarily, you've mentioned some public companies here, but you're not necessarily just public or private, right? You can go anywhere you need to.
That's right. I would say I keep a higher bar for private than public only because of the operational intensity. And so I'd say, 2 equal businesses. If one's public, I'd rather have that, even though we have a long lockup for our capital. So we're sort of a very liquid fund that behaves like a very illiquid one. But it doesn't mean we can't or won't go there. We just have a little higher bar for it because of a big thing I think about a lot is economy of time. And, the economy of time of diligencing a firm that is required to have the kinds of disclosures that publicly traded securities do versus one that's private and you've got to kind of work your network and all that. For 2 equal businesses, you'd far rather have the public one. We did a deal last year that was private, and it was just such a wonderful business with such a talented group of people at a wonderful price. We're going to do that. We'll do that all day. But it was something that you wouldn't dream, you would never find it in public for a lot of reasons. But basically, it was the right thing to do, so we did it.
And more often than not, that's how private markets work,
Mm-hmm.
right? You come across something that's a great opportunity. It's something you want to support, something you deeply understand, kind of like you've just shared with us, right? You take this background, not just with a little bit of exposure to finance, but also the principles that are kind of established in consulting and helping operators build businesses and then becoming an operator yourself. How do we bring all these things together to converge in a way where we can apply it as a portfolio manager? And so when we come across those opportunities, one of the things that we focus on at Mammoth is helping investment managers or wealth managers in the RIA space do exactly that with their own businesses.
Mm-hmm.
Private investments are part of that. And sometimes they're brought by the client or sometimes they're introduced. But as you mentioned, the operational inefficiency sometimes makes it hard for wealth managers to service that line of business.
Very much. Yeah. Yeah. That deal last year, I wouldn't have done if I had to pick up the operational burden. There are pieces of technology that can automate a lot of that. there's still, and I'm grateful and excited you're attacking this space, there's still complexity in stitching the private stuff back into the total portfolio. I mean, even just the basics of, I have multiple brokers and custodians. And so each broker and custodian has a very good analytics package that is worthless to me because they can't piece it together. And so I am grateful that there's just so much room to run. There's so much green space for let's look at things as a whole. And so we can focus on the question, the important questions of, for the next marginal dollar, what's the wisest place to put it?
Exactly. In a previous life, John, I focused on this concept of householding. Mm-hmm. And, it's got a different definition depending on whoever you talk to, but it's exactly what we're saying is,
right.
Like you were saying earlier, measuring risk is all relative. It's relative to the information I have. It's worthless for me to measure risk within a single account within my household. If there's other accounts that aren't being accounted for, and we used to laugh about this because in the simplest terms, compliance offices for broker dealers and wealth management firms tend to require that you have a risk tolerance questionnaire on file for a client. Most of those questions are about how I react to changes in volatility or market conditions.
Yes.
I can't compartmentalize that based on my IRA or a brokerage account or a private investment or how I purchase insurance.
That's a wonderful, I'm really glad you say that. So something I'm very clear about when someone gets interested in the partnership, I say that this is only appropriate for funds that you can choose not to think about. And everybody has a different answer to that. And so I never suggest one for them. But if you're going to look at your statements all the time, that's not the money for this. If you're willing to think that we're, doing things that we believe will, yield fruit, years and years from now. And in the meantime, you can do, your option. We can talk about it all you want. I'll call you once a year and that's about it. Then this is for that. And I agree so much. One of the things I was fortunate to encounter relatively early in life was I realized that for some of the wealth management options I encountered, they were treating, my assets as one pile. And I said, well, look, I'm relatively young. My buckets, which haven't really changed. It's you got to feed your family today. You've got to feed your family over time, kids' colleges and stuff like that. And then there's, sometimes there's stuff you really don't need. That doesn't mean you don't want it. That doesn't mean you don't have things you're going to do, but you would deal with each pile very differently. And so when you get one risk score, it sort of implicitly strips away that thinking about this dollar is actually a little bit more important than this dollar. And I can, for me with the fund, the reason that I kind of hang out in the long bias, long duration space is I really want to get paid for the ability to invest money that is incredibly sticky and long-term. I think we should. And so I've chosen to only deal in that space. But, I say all the time for folks who, they're thinking, if anyone says, what do you think 3 years from now? I say, well, I have lots of ideas for you, but not this fund. And it's just so we can maintain the purity of, when we can play only an infinite game, I think in the long run, we ought to be able to get paid for that, but it requires only being able to play that game.
You mentioned earlier, and I think I got this right, but the economies of time. Let's dig into that a little bit. I actually just read a post on LinkedIn earlier today, and to summarize it, it was kind of silly how most people spend their time earning money so that they can spend their money to try and buy some time.
Yes. Oh, so much. There's so much wisdom in that. Yeah. I forget where I got this, but at some point I bumped into there's this joke of a finance guy from New York, let's say, and they fly to the Bahamas and they jump in a cab. And have you heard this one?
No.
And so they jump in a cab, they're in the Bahamas, and they start talking to the cab driver, and the cab driver's like, what are you doing? And like, well, I'm down here to, look for property. And, one day if I save up enough money, I'll be able to buy it. And then I can, live near the beach and, I can go swimming every day and, eat the good food. And the cab driver says, I do that every day. And there's sort of a beauty in that, I think one of the things that I think isn't widely talked enough about, as a species, however long we've been around, we invented retirement less than 100 years ago. So this idea of, work today, so that I can not have to work for 10 or 20 or 30 years in the future. We're not good at that as a species. We're very unpracticed at it. We've just not had a lot of reps. We've got maybe 3 generations that on certain ends, wealthier, and we've tried it, but we're really just not good at it. I think, in 5 or 10 generations, we'll be way better at it. And so obviously we're all trying to get good at it, but I do think a piece of wisdom that falls out of that is, time is the only asset you can't get more of. The only asset you can't get more of, and we don't even know how much of it we have. And if you really take that seriously, then I think you start working backwards and saying, okay, this can't be a game of spend all my time on this thing over here so that later I can then do that thing. It's got to be much more a game of trade-offs and balance. And I think anyone who's, say a parent kind of gets, you can't tell your kid, I'll play with you in 10 years. You won't have a relationship with them. And so you've got to figure out how to navigate that. I know there are some people in positions where maybe they don't have much choice, and I really feel for them. But I also think there are a lot of people who've chosen to be in that position, maybe not explicitly, but it's just they believe there's wisdom in let's have a miserable 20 years so we can have a great 20 years. And if you really take seriously the idea that time is the only asset you can't get more of, I think you'd solve the puzzle a little differently.
It really is. And there's different ways that we can optimize the problem, right? Mm-hmm. And I think that a lot of people approach these things differently, but far too often we look at our earning capacity as the highest priority thing.
Sure.
I was even thinking of, as you were mentioning that as a parent, the financial services industry has had to evolve, but we came up with these, tax buckets, these ways of saving money more tax efficiently for education. And how many people shove away and maybe even sacrifice decisions today, which is smart to be able to be prepared to pay for an education for their child who maybe decides that they don't want to go to college.
Yeah, very much.
Right. And our industry evolves generally too slow as a way to say, okay, well, maybe you can use that for something else without being penalized.
Yeah. Oh man, so much. Yeah, so much. I think there's a real possibility that by the time our kids are college age, it looks very different from what it does now. I mean, a simple arbitrage that I rarely hear talked about is, the price of degrees in the US is so high now. You can literally go to London or Singapore. My wife and I have both done that and get literally equivalent degrees, sometimes better degrees, depending on what discipline you're in, for a third the money, half the money, a quarter of the money. I mean, top tier global institution. It's just, the economics here versus there. And so there's so much more optionality if you're just willing to kind of zoom out a little bit and try to go first principles, bottom up, to solve the problem instead of just saying, well, Harvard's getting more expensive at X rate. I guess I have to afford that.
Yeah, exactly. No doubt. And we're seeing more and more trade schools and everything else coming back, I think, and becoming more accessible. My daughter is interested in equine studies and she rides horses. And there's a high school here in Massachusetts that focuses on, it's got an equine program.
Sure.
It's something that's like her heart's set on.
Yeah.
But, traditionally that doesn't fit the model. These are all new things that are starting to emerge, I think, to allow people to say, hey, let's follow the path of interest, not necessarily the path of earning capacity.
Sure. And there's definitely something to the extent you believe, as I do, that whatever your job is, it's to serve your clients, serve your customers, serve your partners. In the same way in family, your job is to serve your family. If you believe that, then what those that you serve really need from you is the intersection of what you're curious about and what you're capable of. And I think that's another one. I think you can go first principles on this. The thing you're curious about is the thing you're going to dream about. You're going to think about it in the shower. You're going to think about it over lunch. You're going to get maximum clock cycles and effort on the thing you're curious about. And if you're then doing that in service of others, that's how you can serve them best, the thing you're curious about. And then obviously you must be capable at it. There are all sorts of things I'm curious about, like guitar, that I'm not very talented at. That's why I don't try to be a professional guitarist, and I've never performed for anyone. But, when you can find that intersection of curiosity and capability, that's what others need from you and want from you. And beautifully, wonderfully, that's often also the thing that you need and want from yourself.
Right. Oh, man, that's so good. That's great. I'll give you a plug here. So on your site, you have a Substack and you've done some writing. And one of the threads that I picked up on and read a little bit of is the power laws rule. Power laws rule the world is the sequence that you've been writing here. And if you want to dig into it a little bit, I think it's fascinating. And this whole concept of not just exponential growth and capability, but in production.
Yes.
And you and I were talking about this earlier.
Yes.
The knowledge and capability of the next generation and even our generation compared to the baby boomers.
Yes.
And it's all reflected in how we invest capital. This is all 100% through the lens on how we deploy capital and try and get that compounded return that we mentioned earlier. So
Absolutely.
if you want to pull on that thread, John, I'd love to hear your thoughts.
Absolutely. So let's go to it from two angles. Let's go with what we know of investing and what we know of our human species. So if we start with the human species, I mean, there's this increasing rate of growth. And you can do that at the population level, at the wealth level. An easy one is aggregate production. So, the 19th century, we produced, more economic output as a species than basically all other prior centuries combined. Industrialization helped a lot. Figuring out how not to die. For most of our species, 1 in 2 children were dead by the age of 5. And so we just couldn't sustain population growth because we couldn't figure out how not to die. And so all sorts of things came together in the 19th century, which meant as a species, we produced more economic output than all other centuries combined. We get to the 20th and the 21st centuries, and then we're doing that not in 100 years, in 25 years. And I think it's probably a safe bet that the decade of the 2020s will probably produce more economic output as a species than all the rest of the time that humans have been around. I think that's a fairly safe bet. Now, whether or not I'm right is less important than the direction of travel. But, if you believe we're in a world like that, that's an interesting world. And from an investment perspective, we actually know this, right? So Bessembinder out of Arizona State, anyone who hasn't come across his work, brilliant work. A little summary of it. In 100 years of U.S. capital markets, where we have pretty good data, the top performing 2 to 4% of firms have produced 100% of the net returns in the market. 100%. So that's a distribution that you expect out of venture capital. But there aren't a lot of fund managers running around saying we're not venture, we're not hunting power laws. But actually, it's a case that the top handful of firms were all the action. But it's true, and it scales like a fractal. Today, whatever the S&P does, if we break it down to the return contribution of the 500 firms, there's going to be a handful that drag the thing up today. There's going to be a handful that drag it way down, and 450 to 480, those aren't going to matter today. And so it's, that is true over a minute, over a day, over a decade, over a century. And so we know that of our species. We know that in investing and investment returns. We know that in businesses. I built a business for 10 years, and a good summary of that business would be, we tried about 100 things, and about 2 of those our clients really loved, and they paid very well for those things. They didn't really buy the other 98. And so we know that's the structure, is it's that power law outcome in it. And so if we believe that, both as a species and as investors and as business builders and as operators, even as, relational people, a joke I think about a lot is there's a handful of wonderful things I think I've said to my wife that have really cherished her and made her feel loved. There are a handful of things that I really shouldn't have said. And then there's a big middle. And so what's the logical thing to do? Well, I want to say more of the things that really matter, that move the needle, and less of the things that don't, and none of the things that hurt. And so, if you kind of believe that, then that's power laws rule the world. There are 2 conclusions from this. One is you must set yourself up in a way where you never get taken out of the game. If you die, you don't have a relationship with your wife. If you blow up a fund, you don't have capital to invest, et cetera. If we blow up our species with nuclear bombs, there goes the species. So you must survive. And Charles de Gaulle said, you must survive. The rest is just words. And so you have to survive. And then the second thing you have to do is say, okay, we're going to hunt power laws. So there are places they're found, and then there are also places they're not found. And if you invert this problem, it's often a lot easier to say, what do I know won't be a power law? And there are a lot of just economic attributes of things, think about like very low margin businesses that have a lot of risk and fragility. And so in their best of times, they make a little bit of money. And then there are all sorts of reasons why they could immediately flip to the worst of times and run out of money or take on debt that blows them up. So you can kind of invert it and say, well, where aren't power laws? And then that gives you some hunting grounds for power laws. And so basically you set yourself up, and this is how the fund is structured: survive, and then hunt power laws. And then if you're fortunate enough to catch one or some, you must be structured in a way where you can squeeze all the juice out of them. And so that's in a nutshell. That's how I believe the world is structured, and that's how we're set up as investors and as a partnership.
I love it, John. This has been really good. Great conversation. Lots of awesome jewels. I hope everybody's enjoyed this episode, and I'll let you give a little plug for how they can contact you and learn more about your partnership. And some of the writing that you do is great, and I would encourage everybody to go check out your Substack too.
Yeah, thank you so much. Yeah, easy to get a hold of, and enjoy being in community with people. So please reach out if you'd like to connect. John at phronesisfund.com. That's email, at John Candeto on Twitter. if you Google John Candeto, I have a somewhat uncommon last name, so pretty easy to find. But phronesisfund.com, phronesisfund.substack, most of those iterations, there's something there. JohnCandeto.com is sort of, if you want a portal to all the different things, we go there and it will link to everything else. But we'd love to connect with those that are interested.
Awesome, John. We'll drop that in the show notes as well for our audience to be able to contact you and read more up on it. But yeah, we really appreciate the time today. Thanks for supporting Mammoth and Alternative Universe. Thank you, everybody, for listening to this episode of Alternative Universe. This podcast is brought to you by Mammoth Technology and produced by Turncast. If you like this show, consider sharing it with a friend. You can subscribe to future episodes in Apple Podcasts, Spotify, or wherever you're listening to this episode right now. For more information about Mammoth Technology and Alternative Universe, visit us at mammothtechnology.com. Everything discussed on this podcast is for informational purposes only and should not be considered advice. The participants may have financial interests in the companies discussed on the podcast.